Let's bring in David Bianco here. He's DWS Group America's CIO. David, it's good to see you again. And I guess Nvidia isn't the whole story, is it?
Well, it feels like the whole story lately, and certainly it underlies so much of the excitement in the market for AI. And when we hear from Nvidia, I'm sure they'll paint a very bright long-term outlook. And of course, investors will want to see what they do near-term, given how demanding the valuations are. But there is more to the U.S. equity market than these tech and digital and artificial intelligence titans. And for most of those other companies, we expect this stall in earnings growth to continue at least for the rest of the year and into early next year, probably the first quarter. But earnings growth should pick up later next year, and we'll probably do about 7% earnings growth out of the S&P. However, with where interest rates are, and especially if the 10-year yield keeps heading upward, I'm not sure that's enough earnings growth up against these valuations.
So what you seem to be saying is that the valuations require a level of earnings growth that may not be sufficient to support the prices. So the E's aren't as good as the P's need them to be.
That's right. I mean, we're way past the point at this stage, given the PEs at about 20 for the S&P 500 overall, well above 20 when you exclude financials, energy. And then these interest rates, the bond market is putting up some of the best opportunities as an alternative to equities than we've seen in a couple of decades at this stage. Mm-hmm. So now at this stage, we need more than there not being a recession or earnings not going down. It's time for the S&P to deliver very high single-digit earnings growth. And I think the tech sector is going to need to deliver 20% earnings growth next year to support these valuations.
So the implication of what you say there is, to me, that you expect the market to correct equities.
Yeah, we do. We do. We think it's going to be a tough autumn because we do not expect the Fed to talk about cutting interest rates anytime soon, and it's really possible another hike comes. But more importantly, the long-term yields, 4.3% on the 10-year yield, 2% on 10-year TIPS rates, long-term real yields. This is the type of interest rate environment that normally comes along with a 16, 17, 18 PE, not 20. So these interest rates, without a rapid acceleration in earnings growth very soon, are going to make a tough autumn. And I think, unfortunately, the deficit is contributing to the anxiety in the bond market. And over the coming year, I think you'll have a lot of politicians talking about probably a need for higher taxes.
The deficit, because the deficit requires a lot of new issuance, correct? And if you don't have the bidders in the market, one bidder being the Fed, another bidder being China, another bidder being Japan, in the market at the same levels that they have been, the end result is almost definitionally higher interest rates, correct?
That seems to be the path the market's on. And at this stage, we are still at interest rates that are still well below historical norms. So it's hard to know where the ascent in long-term yield stops. We do think there's very good reason for the 10-year Treasury yield to stay more in about 4.25%. So maybe back up a little bit here, but it's going to require the Fed sticking to its guns on its 2% inflation target, no higher, definitely not 3%. And I hope we'll hear more from Chair Powell at Jackson Hole about how committed they still are to that 2.0% long-term inflation target.